So we've certainly seen more volatility in markets in recent days. The US market alone had its biggest one-day drop since August of 2011. In terms of what have been the drivers, a lot of the activity has been from volatility traders. So the pullback hasn't really been driven by a decline in economic fundamentals. There's certainly some concern about the potential rise in interest rates in the US on the back of improved indicators such as improved wage growth numbers. But really, it hasn't been a fundamentally driven pullback. And it's also important to keep in mind that the pullback comes on the back of some very strong returns in equity markets in recent years. So if you look at the US equity market, over the last year it's returned around 23%, if you look at the S&P 500. And the Aussie market as well has had a solid return of about 14% if you look at the ASX 300. So we've had a pullback, we've had some more volatility, but that's, I guess, following a period of pretty solid returns in recent years. In the short term, we think fundamentals remain strong. So if we look at some of the key economic indicators such as GDP growth, we look at some of the manufacturing indices such as the PMI, if we look at things like the unemployment rate across key economic regions, those things are still supportive of growth. So I think while we've had that increase in volatility, the fundamentals still look okay. Things to think about are, I guess, the trajectory of interest rates and whether that we take a smooth path or whether the central banks look to more aggressively hike rates. Now, that is what the market is watching because I think we've had a backdrop of very supportive monetary policy for equity markets, and any unwind will need to be done in a constructive and measured way. So they're the things to really watch, and obviously on the back of that, things like the shape of the yield curve will become important and where inflation is going. They're the key things that investors should be thinking about. In the last several years, we've had very strong markets, and it's certainly been an environment which has been conducive to just having exposure to the market, so just beta exposure, because all markets have generally gone in one direction, and that is up. If we do see a period of increased volatility, we think there's really an opportunity to diversify portfolios, and that's diversify portfolios by strategy. So yes, still continue to have some exposure to the market via beta, but consider other strategies that can potentially help manage volatility, such as some alternative strategies, some multi-strat alternative strategies that can take directional positions on currencies, on regions, on individual securities, but then also more conventional equity strategies that maybe have the ability to protect on the downside via their mandate structure. And in terms of fixed income, if we are going to a period of potentially increased interest rates, again, looking for managers that, yes, provide you that duration exposure, but also managers that have flexibility in their mandate that are maybe more absolute return in focus. So going forward, we think that's going to become increasingly important, and from advisors working with their clients in constructing portfolios, ensuring that you have elements within the portfolio that can act as a buffer and provide you other sources of returns and diversification will be important.